Right, well, we'll get started now, and there might be a few more join over the next few moments. So hello, thanks for joining us today for today's Monitor Explained webinar. This will be taking a deeper dive into the fourth and final issue of Monitor for 2023. This is our quarterly report that gives you an up-to-date view of the current non-energy costs. A little bit of webinar housekeeping before we get started. So this session is being recorded, so it can be shared with you afterwards, and for anybody else that couldn't join us live, so this will be available to watch on demand by yourselves and them. If you have any questions throughout, please submit these in the Q&A function. We'll either answer those now or at the end of the presentation, and we do have time allocated to run through those with the experts that are joining us today, and any that we can't answer today, we'll make sure that we get back to you after the session with responses to those. So, market insight. If you're a customer and you haven't got your copy of Monitor yet, it's a useful guide, and you can access this by logging in or signing up to EDS Market Insight Portal. The address should be displayed on the screen now. The Market Insight Portal is your gateway to the regular updates, and it's there to help you make the right decisions for your business and have access to quality data and expert analysis to help you navigate the complex commodity market. So joining us today, I'm Joe Shepherd, Senior Account Manager at EDF Energy. I'll be hosting today's session, and joining me, we have technical experts from the Wholesale Market Services team. We've got Dave Edmonds, Senior Manager of Retail Services. We've got Dan Menifee, Costac Senior Analyst. And we've got Hugh Boyle, Costac Senior Analyst. David, perhaps you could start with a quick overview of what we're going to be talking about today.
Yeah, absolutely. Thanks, Joe. So in terms of the agenda, previous versions of this, we've talked about what's happening in the wholesale markets. We're not going to touch on that too much today, other than really to say there's been a bit more stability. Prices are gradually coming down. Well, they're still moving around a little bit, but what that really means is there's not particularly any new news as such driven by the wholesale markets. So we'll focus on a few different topics today. First of those is going to be inflation, which I'll talk you through. And then Hugh will give an overview of the British Industry Supercharger and the impact on energy intensive industry exemptions. And then we'll finish off with a bit of an update on a few topics on the Contracts for Difference scheme that Dan will take us through. So starting with inflation, if I jump straight in. So key thing that we've seen recently on inflation is the Office for Budget Responsibility have updated their inflation forecast in late November following the government's autumn statement announcement. The key thing that's happened is they have increased their inflation forecast across all periods that matter in terms of forecasting costs within the energy industry. So you can see on the charts, they've moved from the blue line 6 months ago to the orange line, and there's been an increase there, as well as inflation having been outturning higher than was forecasted by the OBR back in March across 2023 so far. In terms of what that means for non-energy costs, the four key costs that are most obvious of the impact that comes through are the renewable obligation and the feed-in tariff in terms of RPI, or the Retail Price Index, and then also the capacity market and the Contract for Difference schemes in terms of CPI, Consumer Price Index. All non-energy costs are indexed in a slightly different way. I won't labour the detail of it. You can see on the chart there, which tries to capture some of the different months they're referred to and some of the different inflation rates that are there. But the most direct link that's visible is on those four non-energy costs. There are also impacts on TNUoS and DUOS charges, albeit because they are fixed in advance by the network companies. It's not always entirely clear what assumptions they will build into rates before they fix them. So there can be some lags in terms of when inflation eventually flows through on those costs. But they do also index back to inflation as well. In terms of the size of the impact that we've been seeing, so it's been a bit of a common trend over the last couple of years that inflation keeps increasing beyond what the OBR have been forecasting. This latest update does come on top of previous uplifts, but this in isolation adds around £1 a megawatt hour to April 24 charges compared to what we're expecting previously from the previous inflation forecast, and adds around £3 a megawatt hour in the April 25 year because of the cumulative effects of multiple years of inflation as you get further ahead. Those increases are expected to continue as we go into later years as well, because of that effect of keeping building on previous years' price rises as well. But obviously much more uncertain the further ahead we get. I think the other point, just to be clear on with this, is it is a forecast from the OBR. So lots of these costs, the main exception being RO for the April 24 year, will actually be indexed to what inflation outturns at. So this is a prediction of where inflation is going to go. If the OBR are correct, that will be the impact. But obviously it could be higher or lower still, depending on where inflation ultimately outturns in each period.
Thanks for explaining that, David. Hopefully the OBR forecast is wrong. We don't see such a large increase in the costs. Hugh, David mentioned there's been a big policy announcement on the British Industry Supercharger. Could you just talk us through that and what that means?
Yeah, sure, can do. So just wait for the slides to catch up. So apologies, this is meant to be a maths lesson, but I'll try and go through the slides in as little detail as possible. Just to recap on the British Industry Supercharger, this is reform proposed at the beginning of the year to help support energy-intensive industries, which are deemed to have higher costs than overseas peers. And energy-intensive industries, there is a list on the Department of Energy Security Net Zero website, but essentially it's industries that have disproportionately high energy costs. So there's a threshold, I think it's about 30% of your direct costs are energy costs. You qualify as an energy intensive industry or EII. EIs currently do get a lot of support. So this is more towards some of their policy costs. So if you look at the sort of top left-hand side of the slide today, they get 85% relief from RO, FIT and CFD charges. And what that means for other non-exempt customers is that they pick up that share of the bill. So just looking at the sort of equation there, all the costs of those schemes, normally you would spread those across all demand. That gives you your £1 a megawatt hour rate. If you take away that 85% of EI demand, you've got a lower denominator. So the £1 a megawatt rates, everyone who's not exempt, go up. What the British Industry Supercharger is building on that existing 85% relief for those three policy costs by firstly introducing relief for the capacity market supplier charge as well, so covering all costs that broadly might be deemed policy costs altogether, and also increasing the relief for all four of those costs from the current 85% to 100%. So EIIs will not contribute to any of those costs at all. And if EIIs aren't contributing, the £1 million of all those costs is unchanging. So everyone who's not exempt is going to be contributing a little bit more. So that's sort of the top right hand side of the slide. They're just showing how that's changing in April 2024. And those changes, it's worth noting, have been confirmed. There are other proposed changes which are looking at doing something similar but a little bit different for network costs, and that will be giving EIIs compensation for 60% of their network costs, as opposed to the 100% exemption they get from these policy costs.
And will those network costs be going up for non-exempt customers as well?
No, it's a good point, Joe. So this is the difference between exemption and compensation. So with the policy costs, EIIs are exempt. They just don't pay towards those schemes. Everyone else pay a bit more. For network costs, different types of customers pay different amounts. For instance, half-hourly customers pay on one basis for Chinos through the tried scheme. Non-half-hourly pay a 4 to 7 year-round charge. It's a bit harder to model exemption for EII customers, and could lead to distortions. For instance, network costs in some ways send signals through like the red, amber, green charges on the dual scheme. And so those have been left untouched. So upfront, EIIs will pay all of their network costs 100%, but then through a new non-energy cost, what's been deemed the EII support levy, that will collect money that will compensate them for 60% of their network costs. This will be, as proposed, all of their actual outturn costs. So for EIOs, all the DUOS, TNUOS, and BSUOS costs they incur, 60% of those will be smeared across all the industry as this new EII support levy. Now, the idea is to also have this in place for 2024, but it has not been legislated yet. It's still a consultation, still a proposal by the Department of Business and Trade. So we're hoping to hear more on that in the new year.
Is there anything else to note or next steps on that one at all?
I guess, yeah. So really, we're waiting for the administrator of the scheme to be appointed so they can really flesh out in a bit more detail how this is all going to work. We're expecting that very soon, although admittedly it is near the year end, so that may slip into Q1 at this rate. And then really just watching for the legislation. Like I say, that should be is aimed to be in from spring 2024. And really just looking at any other changes that might make it into the final proposal. So as of now, everything I've talked about is what is being considered. Other things that were proposed early in the consultation but haven't been written out completely yet may include changing how do you define what an EII is. As I mentioned at the beginning, broadly, it's if you have 30% of your energy costs so your direct costs are energy costs, you may qualify as an EII. There could be an expansion of the eligible industries, though that isn't currently being tabled.
Okay, thank you. I think we've also had some interesting updates on the CFD scheme. Dan, could you just tell us a little bit more about that, please?
Yeah, thanks, Joe. So we've seen recently that the Department of Energy Security and Net Zero, or DESNZ, have confirmed the AR6 core parameters, including the delivery years, the pot structure, and administrative strike prices. So the administrative strike prices are basically the maximum strike price that a given generator for a technology can potentially get in the auction. This is off the back of the disappointing AR5 results we saw earlier this year, where no offshore wind projects were successful in securing a CFD. This was because of the low administrative strike prices that were allocated and the inflationary supply chain and construction costs, rising interest rates, etc. So there was quite a lot of industry response off the back of that, and the government appear to have responded by significantly increasing the strike prices for all technologies, as you can see in the top left table, particularly for offshore wind. The strike price in AR5 was £44 per megawatt hour. That's gone up to £73. This is in 2012 prices. So inflated up to today's prices, that's more like close to £100 per megawatt hour. So very big increases. Additionally, offshore wind now has its own pot, so it'd be in pot 3, whereas in AR5 it was part of pot 1 technologies along with the other established technologies like onshore wind and solar. So now it should, in theory, have less direct competition. So yeah, we do expect in AR6 for there to be more offshore wind securing a contract. As we can see, the delivery years, the very first delivery year would be for 26, 27, and then up to 28, 29. So no impact really in the short term. This is sort of looking a few years ahead. And then budgets have yet to be confirmed by DESNZ. So this would sort of define what potentially the maximum capacities that could be awarded, but we expect those to be confirmed probably in March next year. With these increased strike prices, it's quite likely that generators will receive CFD payments on average, but this very much depends on where wholesale prices go.
Okay. Thanks, Dan. In terms of the actual CFD developments that we're seeing today, Have there been any kind of like recent changes or updates that would be useful?
Yeah, we've seen a few interesting updates, mainly relating to baseload generation this time. So a couple of points here, really. As I suppose looking at the chart on the top right, you can see the monthly generation, CFD generation split by intermittent and baseload, and you can see a sharp increase from October this year after about a year between October 22 and September 23 of almost no baseload generation at all. Yeah, a couple of reasons behind that. Firstly, Teesside biomass plant have finally started its CFD at the end of September after years of delaying their CFD start date. Yeah, there was a lot of uncertainty whether they would even start at all, but they have eventually now started and have been generating since the start of October. Secondly, the other two sort of big biomass projects, Drax and Lynmouth, have started resuming their generation again at the start of October after about a year of very little generation. So in that period between October 22 and September 23, the baseload market reference price, or the BMRP, which is used to sort of calculate their CFD payments. So they get CFD payments equal to the strike price minus that baseload market reference price times by the generation. That BMRP was set at very high prices between 2022 and 23 of around £400 per megawatt hour and £200 per megawatt hour across summer and winter seasons. That was much higher than their strike prices, so therefore those generators would have been paying back into the scheme for any generation, which also coincides with the period when there was very little generation. While the BMRP, or the basic market reference price, was very high, we saw that the out and day ahead prices ended up sort of falling much lower than that. So that presented an opportunity for those generators to sell at the season ahead stage, as they would sort of normally do in line with the BMRP calculation, and then buy it back at a much lower price. For example, on the day ahead markets, that effectively means they don't generate at all, and they would save on their fuel costs. And this, as it turns out, was more profitable than generating as normal and sort of receiving their CFD strike price minus any fuel costs. So this is what we believe has happened, but there may be other factors at play, including outages, etc., which may have affected their generation profile. What we've seen since October this year is that now that BMRP has been set at a much lower level, as it's calculated on season ahead prices. So it's more like £130 now for the current season. That's slightly lower than the strike prices, so those generators are now receiving top-up payments again for any generation they output, and they are now outputting at much higher levels. Additionally, the day-ahead prices, while they have fallen a bit compared to the season-ahead price, they're not significantly below that season-ahead price of 130. Therefore, there's less opportunity for them to sell at season ahead and buy back on the day ahead, and it means essentially that it's more profitable for them to start generating and receiving their CFD strike price minus any fuel costs. Because these generators are now receiving CFD payments again since October, it means that there are sort of higher costs now for suppliers as there are more CFD payments going out with generators. However, as we can see from the bottom right chart, which shows the monthly CFD payments, again split by intermittent and baseload, the baseload payments are actually very small compared to intermittent. The reason for that is because even though the generation has been quite big, the difference between the strike price and the market and their baseload market reference price is actually very small at the moment. So in terms of the actual pounds payment they're receiving, it's quite a small top up. However, if the current trend of falling wholesale prices continues, we may expect that for summer season next year, which would be from April to September, that may have a lower base load market reference price, and therefore we may expect higher CFD payments from April onwards for these generators if that trend continues.
Thanks, Dan. Looking forward over these next few months and into the new year, do we expect to see any further upcoming changes?
Yeah, so according to the CFD register, which is a public domain register published by the Low Carbon Contracts Company, there are a few generators, mainly offshore wind farms, that are expected to come online over the next year or so. Two in particular expected to start in March and April. So this includes Hornsea Project 2 and Moray East wind farms with combined capacity of over 2 gigawatts. These sites are fully commissioned and generating. However, it sort of remains very uncertain as to what they will actually do, whether they choose to start or potentially delay further to potentially take advantage of higher wholesale prices compared to their strike price. We've seen with both of these projects, they have previously delayed over the last couple of years. So, for example, Moray East were originally expected to start in April 2022. They delayed by a year to April 23 this year, and they subsequently delayed again another year to April 24. Similarly, Hornsea Project 2 expected to start April this year, but they also delayed to April next year. These generators have strike prices of around 70 to 80 pounds per megawatt hour, so fairly close to the current levels of wholesale prices. So it remains really uncertain as to what they might choose to do. We might expect if prices were to rise, they might choose to delay their CFD start date further and benefit from higher wholesale prices. On the other hand, if prices were to fall, we could see them starting sooner. In either case, it could add to more CFD costs. It's worth noting that generators on the CFD scheme, they can generate anytime within their what's called a target commissioning window. It's set within their contract. That's a window of 1 year length. So they can start anytime within that, receive their full CFD agreement for 15 years. They can also start after that up to their long stop date, which is for offshore wind farms is 2 years after the end of the target commissioning window. However, if they start within that period, their CFD agreement gets reduced by however long they go over. So while we might expect generators to delay, we probably wouldn't expect them to go over that long stop date, because then they might risk their contract becoming terminated. The other interesting thing we've seen recently was Dogger Bank A, another offshore wind farm with combined capacity of about 1.2 gigawatts. They recently announced a 6-month delay from July 2024 to January 2025. It's not known what causes that is, whether it's for commercial reasons or operational reasons. It could well be due to operational reasons because they are not yet fully operational. I think they've only just had their first power output in October or November this year. So it may well be due to operational reasons. With a strike price of £50 per megawatt hour, so much lower than the current view of wholesale prices, they would likely have been paying money back into the scheme. So therefore, that delay means less money being returned from generators into the scheme. So it's something we're monitoring very closely and keep an eye on it. And potentially at the next webinar, we may have some more updates for you on that.
That's great. Thanks, Dan, and Hugh and David as well. So that brings us to the end of our prepared content, but we have some time for questions now. So if you've got any, please do use the Q&A function within Teams and submit those in there. We do already have a couple that have come in. So Hugh, I think.
Okay, Joe, before we begin, so to go rogue,
Yep.
There's one part I forgot to update on the British Industry Supercharger. Then if we could
Sure.
pivot back to that quickly before we get into questions, and then hopefully gives people a chance to get questions brewing in the back of their mind. It was just going to be, I forgot what does it mean, pounds a megawatt hour. So we did share some materials in the Monitor report itself. There's some links in there to the Department of Business and Trade proposals. They're estimating about £1 to £2 a megawatt hour from this, of which it's broadly 50-50 impact from the exemption and 50% from the compensation from network costs. It's a bit high level. Some of these costs are dependent, like CFD Dan was talking about just then, on day ahead prices, and capacity market auctions vary significantly year to year, but it's a broad indication of the sort of impact it will have if all of those proposals are brought forward. Sorry, that's all. Happy to go to Q&A now.
No, that's fine. We've got a couple that come in, and we've already got them. So one of the first ones, I think this one's for yourself, Hugh. Is there an update on RO mutualisation?
Yes, yeah. So good question, very topical. So we have had RO mutualisation for the previous 5 years. This is the first year that RO mutualisation has been confirmed. It has not been triggered, and this is for the April 2022 delivery year. So there was about 7 million in late payments due at the end of August, but by the end of October late payment deadline, that had essentially all been made whole. So well below the mutualisation triggers, which I think are about sort of 60 odd million for England and Wales, and about I think 1.5 million for the Scottish scheme. So good news all round, no mutualisation. But probably worth adding on there as well, sort of looking ahead to the April 23 year, there have been changes in place since the start of this financial year, which require suppliers to essentially earmark RO receipts and keep them, or ring fence, I think is the term that's being used. So if more suppliers do exit the market in future years, hopefully those RO receipts should be protected, and you're much less likely to see mutualisation going forward as well.
Okay. Thank you. We've got some more coming as well. So what's the latest on Besuos? Should we still be worried? I think that'll probably come to yourself, David.
Yeah, I'll take that one. So I guess just to take a step back probably from there in terms of just, because we've not talked about Besuos this time, a recap of how the Besuos rates are set now. So National Grid are required to fix the Besuos rate for a season at a time, 9 months ahead of the start of that season. So for the coming winter period, next winter, they will set the rates at the end of this month for what that will be. And then in theory, those are fixed from that point forwards. Although if National Grid have to ultimately pay out more money to keep the system in balance through Besuos costs, then they do have the right to change that rate and recover more from suppliers and consumers should they need to. So it's nominally fixed, but not necessarily fixed if more extreme costs outturn. In terms of what we've been seeing, so probably tackle this season by season. For summer 23, which is the summer just gone, we saw very low outturn of Besuos costs compared to the rate that National Grid had set. So National Grid actually over-recovered by around £350 million, which is good news because that's money that they'll hand back through lower rates in the future. That season's obviously now finished, and we're now into winter 23. In terms of how winter 23 is progressing, it started off with quite high costs. So in October, we did see costs quite a way above the rate that National Grid had set. But then in November, actually, we've seen that be below the rates that they set by a similar amount. So actually, winter to date, we're broadly in line with where National Grid set the rate. And so they're recovering approximately the right amount to pay generators for their actions. That could obviously change going forward. There's still 3.5 months of winter to outturn. Q1 can be particularly volatile in terms of the weather, so it's a bit of a watching brief, but it's looking less and less risky that National Grid will need to open up that rate and change it because they have got the cash reserves built up from low summer outturn that's already happened. Looking a bit further ahead, summer 24, so that rate has already been set. That was set at the end of June, and that was set a little bit below £8 a megawatt hour, which included an assumption that around £400 million worth of over recovery from summer 23 would be passed back to suppliers and consumers. So essentially National Grid are expecting the cost to outturn higher than that, but we're expecting to have some cash to pay back as well. So to get to a balanced position at the end of summer, they set the rate lower and expecting to net pay back a bit of cash through that. Now, because the summer outturned a little bit higher than National Grid were expecting at that point, they've recovered a little bit less cash. So they're starting a bit behind, but not massively. And then the really key assumption is what happens for the rest of winter. Because obviously, if they're expecting to have cash to hand back over next summer, if they need to hand some of that back this winter because cost outturn starts to increase, they might not have as much cash as they're expecting to. And if they then see high costs in the summer, there may be a need to change that rate. So for the bit of the question of should you still be worried, I think that's maybe what the first season where there's a more realistic risk that the rate could open up, but still very uncertain and not necessarily something that will happen. And then finally, winter 24. So as I mentioned, that rate will be set at the end of the month. It'd be interesting to see where National Grid set that, given some of those movements I've talked about of lower outturn and then broadly in line, but an assumption that some money will be given back. So we're sort of waiting to see. I think the draft rates were very low for winter 24, but that was based on an assumption that there would be quite a big over recovery across this winter. That's not currently happening. So it may well be that the final rates are set higher than the draft rates. We'll find out in a few weeks on that one. And that may well be a topic at the next webinar.
Okay, thanks for that, David. And we've had another one come in, Hugh. This might be partially covered already by yourself, but what is the power per megawatt saving for EIs following the increase to 100% exception on RO fit, CFD and CM?
So the DBT, so Department of Business Trade estimate, I think is about £20 a megawatt hour overall saving, and again broadly £10 a megawatt hour from increased exemption from policy costs and about £10 a megawatt hour from network costs. That was their initial estimate. I think they have in their initial proposal, I think they were looking at somewhere between possibly up to 90% exemption from network costs. They've now settled on 60%. Although EIIs tend to have higher network costs than average, so that's our best view for now. But that should, I think, broadly the £20 a megawatt hour is the premium. DBT sort of perceived that British industries were disadvantaged compared to, say, overseas peers, and that's what they were trying to bring down to make the sort of costs for these industries more comparable. Like I say, in spring, in the new year, we should get a bit more sort of robust numbers from the eventual administrator for the scheme once they are appointed. So hopefully have like similar to Besillas, hopefully by the next one of these sessions we'll have a bit more news on that.
Okay, I think that brings us to end of all the questions we've had there. So thanks for all the questions and thanks David, Dan and Hugh for sharing some insights.
Sorry, Joe, I think there's one more I can see. I think a question about whether what the percentage of price increases might be for the 24-25 year, I assume compared to this year. I guess the key thing to mention up front on that is for each customer it could be different, and each site it could be different. So particularly Duos and Tenuos charges vary at a site level. So can't give specifics on that. In terms of the general picture, I think it's probably roughly a 10% increase from April 23 to April 24 across all non-energy costs. Most of that is inflation. So as we're updating on, inflation has been very high. Lots of the costs are indexed to inflation, and that's driving, I think, most of that 10% or so increase. There are some other things as well that muddy the waters a little bit. So on Duos, in the report, you'll probably see there's quite a big jump in terms of the total revenue that DNOs will need to recover. That's partly inflation driven, but also DNOs under recovered during the previous year, and they have the ability to then pass through some of that into the next charges that they're setting. So that's a reaction to that. on the flip side with Besuos, that goes the other way of where I was just saying National Grid have over recovered. They're passing some money back, so there's some overs and unders as well. But yeah, I think generally about roughly a 10% is probably a good starting point to assume.
Okay, thanks for that one, David. I think that does now bring us to the end of all the questions we've got in there. So thanks very much for responses to those. So for those who have questions around the UK power market or energy policy, we recently hosted some webinars with energy trader James Chaplin, and Net Zero Policy and Strategy Director Rebecca Bresford. You can access recording by heading over to the edfenergy.com and the Talk Power events page. You'll see that on your screen now, and look out for our future programme for the events in there for 2024. Dates coming to the page soon. They haven't been confirmed yet, but they'll be put in there. And I guess finally then, closing us off, so this is our last webinar for 2023. We just want to say thank you for all of you as our audience for joining us across the year, and we hope that we've kept you well informed. We would love to hear your feedback to help us continue to deliver the right content for you across 2024 and further on. So we'll shortly be sending out some feedback surveys along with the recording. So it'd be really useful if you can feedback any insight, content you've got there. And finally, if we didn't answer any questions today, please feel free to get in touch. Our details are on the screen now. So that's you can email us on the Talk Power Let's Talk Power at edfenergy.com. And I guess then to stay in touch with all of our latest industry news and updates from EDF, please follow us on our dedicated EDF Business Solutions LinkedIn page, which you can see there on your screen as well. So just a final thanks for joining us, and we'll see you all in 2024. Thank you.
Thanks, Jay.
Thanks for hosting us.
Thank you.
Bye.